Is Kinder Morgan, which is an oil and gas pipeline transportation company, a good dividend stock? Well, maybe. Let's take a look, and you tell me what you think in the comments below. I'm going to be using two websites here, Seeking Alpha and MarketWatch. You can also go right here to my website, click on the menu, and you will find this entirely free resource guide with all the links that I use to do my own research. It is entirely free. You saw there was no email sign up, there was no Patreon or $10 to unlock it. It's right there and it's free. So here we are on Seeking Alpha, and we can see Kinder Morgan is $18.31, and they pay a 6.23% dividend. That's really high, and it looks good, right? High dividend, low price per share. However, when we click on the last 10 years, we can see that the stock has actually fallen dramatically, which makes that dividend look a lot higher. Over the last 5 years, it's also down 7%. And in the last 12 months, it's up a little bit. Year to date, it's up a little bit. But the benefit of a website like Seeking Alpha, and yes, you need a premium account to get this. If you click on my link tree in my bio, there is a $50 off coupon for the 1-year subscription. If you're interested in trying it, if you're not, no big deal. Now, we can see that their dividend is 7.15%, and they've got 6 years of dividend growth, which is good, but their payout ratio is not great. It's 105%, and this is a portion of their net income paid out to shareholders every year, and it's 105%. When you see a payout ratio that's low, it's a good sign. It means that the company can continue to raise their dividend over many, many years. When you see a payout ratio that is high like this, it generally means that they're not going to be raising their dividend that much, or they're paying out way more than they could, which could indicate dividend cuts. And if you click on dividend safety, it will show you how they get this grade. And a lot of this stuff is not looking good. Now we're going to jump over here to MarketWatch. I'm also on Kinder Morgan, and we're going to click on financials and just take a look at the revenue for a second. It's kind of all over the map. I mean, this is COVID related. Then it looked to be doing very well in 2022, but 23 it dropped a little. It actually dropped a lot, 22%. Their net income is kind of also all over the map, but did also drop 6%. And take a look at Kinder Morgan's cash and short-term investments over the last few years. $1,794,000,000, 96 million. That's a red flag. That's pretty concerning. But their free cash flow, which is all the way down here at the bottom, did increase last year, which is a good sign, but it didn't have a great year last year. A payout ratio over 100% is not good. That means that they either need to cut their dividend or find a way to generate a lot more revenue, a lot more income, so that payout ratio number can come down a little. A high payout ratio could mean that they're going into debt, they're borrowing money to pay a dividend, that's not sustainable, or they're going into their cash reserves, which could dwindle over time, also not good. I want you to let me know in the comments below if you think Kinder Morgan is a good dividend paying stock or not. Thanks for watching, smash that follow.